Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2026, January 20th, and today the market mood is, please don't make me pick between stocks and bonds, because both are acting weird.
I woke up, checked markets, and it felt like my portfolio tried to leave the group chat. Like, it's not you, it's geopolitics.
Three big threads today: the Sell America narrative, a sudden Japan bond market jolt spilling across assets, and a global Fintech IPO angle with Brazil's PicPay aiming to raise about $434.3 million in a U.S. listing.
So we've got America getting side-eyed, Japan bonds doing parkour, and a Brazilian fintech going, "Hi Wall Street, please love me." Cool, cool, cool.
Story 1. Multiple market wraps are using the phrase "Sell America." The gist is investors are reducing exposure to U.S. assets, think dollar and Treasuries. At the same time, risk sentiment is shaky, tied to tariff threats and U.S.-Europe tensions.
Wait, selling Treasuries is like refusing the safe option at the buffet. Isn't that the one thing you're supposed to grab when markets panic?
Exactly, and that's why it matters. Normally, risk off means stocks down, Treasury prices up, yields down, dollar up. A Sell America tape can look different. Stocks down while Treasuries also get sold, pushing yields up, and the dollar softens because the stress is about U.S. policy credibility or trade conflict, not just growth fears.
So it's like if your friend is usually your emergency contact, but today you're like, actually, I'm calling literally anyone else. That's spicy.
Finance mechanics in plain English. When Treasuries sell off, yields rise. Higher yields can tighten conditions. Mortgage rates, corporate borrowing, even the discount rate used to value growth stocks. Imagine the market's measuring tape suddenly shrinks. Future profits look smaller in today's dollars.
Yes, the discount rate. The financial equivalent of, I don't care what you'll earn in 2032, I'm tired right now.
Why it matters for normal people? If yields jump and the dollar drops, imported goods can get pricier and financing costs can rise. For investors, it's a reminder to stress test portfolios for weeks when diversification fails, when both stocks and bonds wobble together.
So what's the actionable move, besides me dramatically whispering, "Cash is a position," while I clutch my coffee?
Actionably, 1. Check your rate sensitivity. If you're heavy in long-duration assets, you're basically long low rates. 2. Consider whether your bond sleeve is overly concentrated in one maturity bucket. 3. If you're buying, scale entries. Don't go all in on a single headline day.
Okay, let's talk Japan. I saw sudden Japan bond crash, and my brain went, how can a bond crash be sudden? Aren't bonds the slowest drama on Earth?
Story 2. Reports describe heavy selling in Japan's massive bond market, with the move accelerating quickly and then spilling into global rates. Japan's bond market is enormous, trillions in size, so when yields jump there, global investors reprice risk elsewhere.
Explain it like I'm 5, and also like I just discovered bonds aren't guaranteed vibes.
It's basically like this. Bonds are IOUs with a fixed coupon. If investors suddenly demand a higher return, the price of the existing IOU falls until the math works. Now scale that up. If big funds have leverage or risk limits, a fast price drop forces them to sell more, like a crowded exit.
So it's not Japan did a thing. It's everyone who owns the thing had to hit the eject button at once. Bonds, now with horror movie sound design.
Why it matters. Japan has been a low-yield anchor for years. If that anchor lifts, global yields can drift higher. That can pressure equity valuations and raise funding costs for governments and companies. Even if you never buy a Japanese bond, you feel it through rates, FX, and risk appetite.
This is why my diversified portfolio sometimes feels like 3 different ways to lose money at the same time.
Practical takeaway: if you rely on bonds as ballast, know what kind you own. Shorter duration, high-quality bonds typically swing less than long duration. And if you're near-term cash flow dependent, like tuition or a home down payment, match maturities to your timeline.
Now the fun one. Brazil's digital bank PicPay aiming to raise $434.3 million in a US IPO. That's either confidence or the financial version of, I can fix him.
Story 3. PicPay's IPO target is a signal about cross-border capital markets. When a fintech goes public, investors focus on user growth, credit quality if it lends, and, crucially, funding costs. In a higher-rate world, growth at any cost gets repriced fast.
So the market's like, congrats on the users. Now show me you can make money without borrowing at unicorn-era prices.
Exactly. Simple analogy. A fintech is like a grocery store that also issues store credit. If the cost of financing inventory and credit lines rises, margins get squeezed unless pricing power or efficiency improves. IPO buyers will want to see durable unit economics, not just downloads.
Actionable for listeners. Are we allowed to buy IPOs? Or is that like adopting a puppy you met on the internet? Emotionally compelling, financially unhinged.
You can, but treat it like a high volatility position. Practical checklist, read the risk factors, understand revenue mix, look for credit loss trends if applicable, and decide your max position size before the first trade. And if you're building long-term wealth, you don't need IPOs to win. Broad indexing and disciplined rebalancing still do most of the work.
Recap. Sell America is when the usual safety blanket, dollars and treasuries, doesn't feel as cuddly. Japan bonds reminded everyone that low drama can still jump scare you, and PicPay's IPO is a vibe check on fintech optimism in a higher rate world.
One more quick note. When you see gold strength alongside dollar weakness, don't assume it's one simple story. It can be inflation hedging, policy uncertainty, or just positioning. The move is to keep your plan, diversify thoughtfully, size risk, and avoid panic trades.
And please, if you're doom refreshing charts, hydrate, touch grass, and maybe rebalance instead of revenge trading. Same adrenaline, fewer regrets.
If this helped, subscribe and leave a review. Comment what you're watching most this week: the dollar, global yields, or IPO risk appetite. We'll be back tomorrow with your next briefing on finance and investing.